Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. Joining me today is Rakesh, or Rick Jain, partner and global head of private credit at Pantheon. Rick, it's great to see you again. How are you doing? And of course, thank you for your time today.
Doing great, Todd. Thanks for having me on.
Of course. So just to kick off, I know both private credit and secondaries are very popular terms, in the market. Can you just maybe give us a kind of a setup as to where and how the growth of these two areas are linked today?
Sure. Well, private credit secondaries, although getting more press, getting more notoriety recently, are not a new thing. Our firm has been doing credit secondaries off and on since the late 1990s. So have others. But we really, I think, kicked off the industry by creating the first dedicated pool of capital going after this in 2019. And what we do is we really do two things. We buy LP interests in credit funds, and we also buy portfolios of loans, also managed by third-party GPs to help facilitate liquidity considerations for those LPs in vehicles who are looking for that type of capital. And the reason credit secondaries have started to attract more attention and deal volume has started to grow is because the private credit asset class has now matured and grown to the point where it's a $1.7 trillion asset class, according to various estimates. It continues to grow at high single digits, double digits. Capital formation is strong. You have 1,200 credit managers competing globally in private credit. There's something like 350, 360 direct lenders in North America alone. So you have a lot more capital in the industry, kind of post GFC, and it's growing. You have many more GPs, many more funds, much more in the way of capital formation, and a lot of investors of all different types coming into the market. And so that growth in the asset class is creating opportunities on the secondary side.
Have you seen any of the motivations in secondaries change in recent years? I mean, it seems like it's obviously you talked, it's 1990s. You've been doing it since then, but where it seems like it's having a moment now, and is that, kind of shifted any of the motivations around secondaries?
Yeah, I think the base case motivations have always been around liquidity management, portfolio rebalancing, tactically kind of reallocating one's exposure in different ways. And I think that's existed since the secondaries business generally, whether it's in, private equity or infrastructure or our asset class. I think what's changed more recently is the advent of pools of capital and teams with expertise like ourselves. So it's a little bit like Field of Dreams. Like if you've built it, they will come
Yeah.
because now you've created the capability, the capital, the right cost of capital to facilitate liquidity transactions happening in this market. But you're also seeing some of the impacts of kind of DPI challenges that have impacted the private equity industry, kind of impacting the private credit industry. So I have always maintained that a large part of the duration in private equity or private credit is still correlated to that in private equity. And so DPI challenges there are definitely spilling over to things here. in private credit, and we're certainly seeing that as a motivating factor where LPs are saying, "Hey, if I can, I've made money on this fund, I've made money on this pool of assets. It'd be great to reallocate in some way because maybe I don't need 10 direct lending exposures, maybe I only need five,
Yeah.
or maybe I want to express a different view in the market here on it."
Are you seeing, or what innovations are you seeing around, kind of structuring in some of these deals?
Yeah, I think the real innovation that's happened, and we've been doing this for the last 5 to 6 years, is kind of this advent of kind of GP liquidity solutions in secondaries, particularly in credit, and the notion of a GP deal in our market is very different than private equity, which is obviously focused on maybe one or two assets. In our world, we're really financing 25, 50, 100 different names in a pool where a GP is looking to accelerate liquidity back to its clients. And so the notion of kind of creating continuation funds around large pools of assets, where as the buyer, we can pick and choose the portfolio, we can pick and choose the structure of the fund, how funded it is, what kind of recycling it looks like, and what the GP alignment looks like. That I think has been a huge kind of innovation in the market over the last few years. And, we've been on close to 40 of these types of transactions, some small, some, multi-billion dollar continuation funds. I think that will continue to be a tailwind and illustrative of what's going on in the market for the foreseeable future.
Picking up on that a little bit, it seems like LPs have kind of a plethora of options today. Secondaries, you just mentioned continuation vehicles. There's fund finance, which has seemingly exploded the last couple of
Yeah,
years, NAV loans,
absolutely.
sublines, and whatnot. I mean, how do they view, secondaries versus continuation vehicles versus NAV loans? Like, it seems like they have a lot more options today. How does maybe secondaries compare to some of these other vehicles or options?
Yeah, so I think with a NAV loan or other types of fund finance, they don't completely solve the entire liquidity issue that a seller or a need a source of capital is really looking for, right? So it's you're really levering your portfolio and kind of either optimizing for return or solving only a partial problem. Whereas I think with a secondary option where LPs are going through complete sales of LP interests, or LPs are working with their GP to get wholesale loan monetizations. That seems to be a much more complete and holistic solution that solves much more what they're looking to do. I think, you don't see too many fund finance options around credit portfolios, given the cost of capital of putting on a NAV loan, let's say on a portfolio that's only generating 10 to 12%. The math doesn't work there as much. It may work in the private equity world. But I think in for secondaries and credit, what we're seeing is LPs really wholesale changing where they want to pivot their portfolios and what kind of liquidity they're looking for. But certainly, kind of NAV lines and other types of things are useful tools, in the toolkit of secondary solutions providers. We've looked at a few of those and have provided some select interesting, financing against portfolios. But again, they're more the exception than the rule.
The misconceptions about secondaries, has that changed from, the 90s up until, maybe what we're seeing today? Kind of maybe what are some of those misconceptions and how have they evolved from when you guys first started?
Yeah, no, great question. I think it's interesting because myself and my team, we really came at this market as direct credit guys first. So all of our backgrounds are, either in unsponsored or sponsored or unsponsored direct lending, special sits, distressed, opportunistic credit. So we really fundamentally looked at the world of credit from that lens and looking
Hmm.
at things on an asset by asset basis. And I think what's complex for a lot of people who come from that same background is that when you wrap a fund finance structure around it, um, with levered funds, recycling, tax implications, and the like, it becomes extraordinarily complex.
Yeah.
So where the misconception comes in terms of how you value an asset within that particular structure. So I think it's relatively simplistic to say, well, I think that loan is maybe worth 98 or 95 or 90 or something like that. But I think what's really challenging is taking a point of view on that asset and trying to project loss, trying to project duration within the context of a fund wrapper around those types of things. So I think that's one misperception. I think when people look at this industry and they say, well, you know what, I can analyze a loan tape, I can analyze a portfolio. Well, I think it's easier said and done when you have a lot of complexities going on within a portfolio from a secondary standpoint. The other misconception I think is we see a lot of people who just kind of buy the GP in this
Hmm.
world. So a lot of folks look at the reputation or quality of the GP and they say, well, the portfolio must be good or it must be worth X. And I think there's a big misconception in terms of like GP quality and quality of the portfolio. They don't necessarily align themselves very well.
When it comes to, kind of volume pricing trends within, credit secondaries and the various strategies, senior credit fund, first distress, first specialty finance, like maybe give us an understanding of what some of that looks like today.
Sure. Well, maybe fast forward, looking back 5 years, we probably saw back in 2020, 2019, around 5 to 7 billion dollars of top of the funnel deal flow. Last year we saw about 36 billion
Wow.
of top of the funnel deal flow. So, a really rapid increase in terms of deal flow that we're able to see, deal flow that we're able to source. I think a little bit of the difference also is that we have senior vehicles, opportunistic vehicles, business focused on North America as well as Europe, so our aperture is quite wide. This year, we're already seeing kind of an up 20-30% bump in terms of deal flow. We've already invested through the first 6 months of the year, everything that we did in all of 2024. So to give you a sense of kind of the parabolic acceleration of what we're seeing right now in the marketplace. And it could just be a moment in time where a lot of the stars can necessarily align around capital and opportunity. But certainly we've come off of a very small base 5, 6 years ago. And, we've seen a market increase in the development of liquidity solutions around private credit. And certainly kind of still early days overall as a sub-asset class within private credit.
Can you tell us a little bit more about, kind of what Pantheon looks like today? Obviously, your remit is as global head of private credit. What does that entail? Maybe just a little bit more of understanding of kind of where you guys sit. Is it just
Yeah.
secondaries? What else do you guys do? Give us a little more color around the firm.
Sure. So we're about an almost $80 billion assets under management private market specialist, really around secondary solutions across three different asset classes. We have over a dozen offices globally, 150 investment professionals, over 400 employees, been operating for close to 40 years. So, we have a lot of historical expertise within the private equity asset class. That's around a, 40, $50 billion business for us, kind of real leaders around middle market, private equity secondaries, as well as GP leads, as well as equity co-investments and primaries. And we also have a market leading presence in infrastructure secondaries. So that's about a $23 billion business for us. And we've been doing that for over a decade and change. And then the third leg of the stool, private credit, which is what I'm responsible for, has really come off a really small base. When I started here, we had one fund and $200 million. Now we're kind of closing in on 11 to 12 billion and 30 different vehicles that do all sorts of things in credit secondary. So we too cannot escape the vehicle complexity that exists generally in our asset class, but it's an asset class where you try to tailor things for what clients want in terms of portfolio construction and the like. But I like to think of Pantheon as kind of playing at the intersection of GPs and LPs and trafficking in that information. So we sit on thousands of advisory boards across all of these different asset classes. We're real partners to GPs and LPs in providing access to these types of secondary solutions. And you can imagine, the data and information and angles that we have across that whole ecosystem of private markets can be a real edge from a diligence and investment selection standpoint.
One of the broader trends, and I think Phil Totolo a couple of months back was talking about, 25 years ago, 65% was in public, 35% in private, and that's flipped today. And obviously, some of what you guys do, it directly correlates. Private credit has taken off, and obviously it's gone from 5 billion to 35 billion. Do you see that continued evolution of public to private? Do you kind of see it settling in kind of a balance? Do you think we can go back to having 65% public sometime in the next generation? I mean, how do you see the public private dynamic continuing to play out?
Yeah, the hounds are out. I don't see them coming back. I do see as the private markets have gotten kind of deeper and much more broad, I think for borrowers, for equity owners, these are markets that are deep and sophisticated, embrace innovation. They are much more conducive to financing, whatever you think the biggest trends are going on in our market, whether it's kind of energy transition, AI and data centers, and the like. There is a lot of debate around public and private within private credit, but I do think this is kind of where the market is going for a lot of those reasons, right? Companies can fundamentally get what they need with speed, flexibility, confidentiality within the private markets, wherever it might be. And I think that trend is just going to continue. And you can see it on just the capital formation side too, right? You're seeing
Yeah.
kind of the evolution of where institutions, insurance companies, and now private wealth are going. They're definitely gravitating to where the capital is, and that's because that's where the companies are.
What about the future, tradability, liquidity of private credit loans?
Like my personal view is, private credit is private for a reason. The lenders, the owners value information and confidentiality. They want to know who their partners are. And that kind of scrubs a little bit differently in terms of the way traded credit might work, generally speaking. So, we get asked the question all the time, like what happens if, private credit becomes more publicly traded? Is that a threat to the secondaries business? We don't really think it is. I think it'll be maybe more evolutionary than revolutionary in terms of what happens there. But these are difficult instruments to value. Information is not easily obtainable.
Yeah.
People have different marks, right? It's not surprising to most participants in the private market. Even if you look at BDCs as an example, you can see the same credit marked, very differently across that landscape. That's just a drop in the bucket of the types of things that we see. So I think we're a long way away from kind of where private credit becomes more publicly traded, especially in our parts of the market.
Are there any particular market segments within private credit that you would deem, underappreciated today or maybe are, getting to be underappreciated?
Yeah, look, I think, well, certainly secondaries is one of those markets that I still think, to talk my own book for a second, I think it's one of those ones where people are still learning and still kind of understanding the value proposition for it. And I think when they dig into it, there's a we believe there's an incredibly strong use case for investors around the asset class and the product and what people can get out of it. For the most part. I think people maybe switching over from secondaries to kind of direct lending, I think people like to ring the death knell of direct lending because it is and has become much more competitive, much more commoditized. We
Yeah.
are at a point in time where, spreads are really tight and there's a lot of people complaining about lack of deal flow. They're complaining about competitors who are able to raise, large amounts of retail capital and feel like they're forced or compelled to deploy. I think for a lot of investors, we have over, 200 LPs across our credit business alone, and we speak to a lot of these folks, whether they're family offices, high net worth, all the way up to some of the largest institutions and sovereign wealth funds. When I talk to clients, direct lending works for them. It's a part of their portfolio. It may not have been as attractive with as wide a spread premium as what they're used to, but it works for their book. It works for what they're trying to do. So I think direct lending sometimes gets a bad rap around it, because of all the things that we're all concerned about as participants in the market, whether it's, covenant quality, EBITDA quality, and potentially lack of underwriting discipline. We'll see what happens in this current credit cycle. I think you'll start seeing a lot of dispersion of return around that market.
Certainly a popular topic. It seems to settle down a little bit the last couple of months was kind of the macro volatility from the start of the year. You had a lot of the tariff talk here in the US, which is, though the Canadian US argument maybe picked up again last week. But,
Yeah.
how do you think of not only the volatility, do the clients that you work with on secondaries, do they think of macroeconomics and volatilities? Does it force them into rash decisions? Like, how do you guys kind of, with your investment thesis, does it evolve or change given the macroeconomic things that you've seen the last 6, 8 months?
Yeah, so I wrote our quarterly investment letter, or at least our year-end investment letter, and the title that I had was certainly uncertain. And I don't profess to be a prophet, but the market became definitely more uncertain about a quarter later with everything related to tariffs. And I think when we see that uncertainty premium go up, then the desire for liquidity and risk management goes up. So the
Yeah.
tailwinds around our market, we think, become slightly better. The risk-adjusted returns become slightly better. And we see more volume, we see more opportunities, we can be more selective. We're definitely in an environment like that, where, I don't think you'll see wholesale fire sales of assets, regardless of where they are in secondaries. That's a very rare thing to have happen.
That's
Sometimes
like GFC
yeah,
style
sometimes
stuff.
exactly. Sometimes you'll see the guilt crisis that happens where you have some forced sellers. Maybe we'll see some things kind of pressuring people towards year end. Sometimes you see some regulatory missteps kind of impact insurance companies and they have a desire to sell. But I think generally when you see a lot of this uncertainty, whether you're an allocator or a CIO on the other side, you tend to be a little bit more clammed up around taking risk, and you want to husband capital a little bit more, for a rainy day. And I think that makes a lot of sense from our perspective. So that's what we're seeing on the buy side. When we see that environment, we're really trying to lean into really interesting opportunities where our information angles kind of allow us to, hopefully extract a better risk-adjusted return than we would otherwise get access to.
Do you see any, structuring or origination innovations that will help define, kind of that next evolution of private debt and private credit?
Well, certainly I think, on the structuring side, we're certainly seeing a lot more private credit insurance partnerships happening.
Yeah.
And certainly many of your other guests have talked about this, and we're certainly seeing it in a tremendous way, where insurance companies are trying to get access to more capital efficient solutions, IG rated exposures, to help manage their risks and obtain, kind of the appropriate net interest income spread, in their own books. So whether that's, insurance partnerships, collateralized fund obligations, rated feeders, those are certainly things that I think are defining how investors are getting access to the asset class. We also see, again, I think a very early innings of private wealth interest in different types of vehicles. Obviously, private wealth has been a mainstay of kind of capitalizing the BDC world. in private credit, but I think it's still a ways from penetrating other asset classes like asset-based lending or secondaries that we have. So I think that's starting to happen as well. On the origination side, I'm not sure there's anything revolutionary there from an origination standpoint, but I think you're seeing a number of GPs own the originators in different
Yeah.
ways. They're trying to pursue different ways of kind of owning the asset from cradle to grave, and get access to those types of opportunities without having to be disintermediated.
It also seems like lately there's at least a few of my guests have recently talked about kind of this drive for retail money as well. The high net worth individual. Are you guys seeing that same dynamic? I mean, we talked about it just at the Fund Finance conference a couple weeks ago. Interval funds.
Yeah.
It seems like there's more trying to tap into the retail investor today than there has been.
No doubt. I think, so our firm has been a real kind of innovator and leader in the evergreen space and in permanent capital vehicles for a number of decades. We were one of the first firms to create a 40 Act fund for private equity, almost a decade ago. And it's not surprising that, within our other asset classes, whether it's infrastructure and credit, we've also pursued, and addressed a lot of the needs that we're hearing from clients to get access to our products. So we do have an interval fund in private credit in the US that we created over a year ago. That's done quite well from both a performance and asset accumulation perspective. We've been very conservative in terms of just the ramp and build up. It invests alongside all of our other vehicles, so there's a lot of alignment across our client base for those types of things. We're doing credit as well on the non-US side. And I think this is just, I think from our perspective at Pantheon, this is just an outgrowth of what clients are asking us to do for
Yep.
them. Because we've had that historical perspective in private equity, many of the clients that we're seeing are just telling us they want access to semi-liquid vehicles. They want access to vehicles that they can have in different types of accounts, and at different minimums and at different qualifying levels. And so I think, at least for us, it's really kind of addressing that need that we see in the marketplace.
We have a couple more questions before we get to the fun questions out the door. Are there any either asset classes or regions that you think are kind of poised for some pretty big growth in the next decade or so? Like, it's seemingly I've talked to a few people about, kind of it seems like Europe might be having a moment now with a lot of the volatility in the US. Is that what you're seeing, or asset classes kind of maybe peer into the future a little bit?
Sure. Well, Europe has definitely become a little bit more attractive on a relative value basis for sure. Our first credit secondary funds back in 2017, 18 were really focused on the European marketplace, first and foremost, actually. So we continue to have a very significant dedicated effort and franchise focused on that market. And as it relates to secondaries, that market isn't as deep as the one in North America. But we're seeing plenty of opportunity to continue to, invest on the secondary side. And I think on the direct lending side, certainly, many of the GPs that we talk to, even down to opportunistic ones, continue to see Europe as quite target rich. Thinking a little bit further out, though, Asia is definitely on our radar screen. So that's a market that's lagged the other markets from just a capital formation perspective. But they're becoming much more developed, much more interesting from a return perspective, perhaps lower risk in certain jurisdictions from a legal and enforcement perspective. So we're definitely spending time and effort and resources to continue to build up our capabilities in that region. So I definitely think the adoption curve will accelerate in that region in a massive way for our asset class.
What's the biggest surprise you've encountered since joining Pantheon?
The biggest surprise. Um, I would say, I've helped build three different credit businesses before I joined Pantheon, both as a business builder and investor. It always surprises me about how difficult it is to stand up the infrastructure for a business in credit. So I think, as the table stakes grow with investors and vehicles and the complexity and all of these different channels, I would just say it's never easy standing up a business and dealing with all of the valuations and the operational complexity and the legal complexity that goes on. So in other words, you always underestimate how difficult it'll be. So I would say it's, a bit of a negative surprise, but not completely so. But everything's here. I would say everything has been as expected. Great culture, great teamwork, great camaraderie, everyone very aligned, very excited to build businesses, even in a large company.
So we have a few fun questions as we look to wrap up here in the next few minutes. Do you have a favorite sports team or hobby?
Well, I'm definitely, being born and raised in Toronto, I'm definitely a hockey fan. So, I split my allegiances between several hockey teams, but since I'm a New Jersey resident, I definitely try to root on the New Jersey Devils. But I'm a sports fan across the board. I play weekend soccer with a whole bunch of mates out in New Jersey since I was like, 20 years old, moving out here. So continued to always cross my fingers to avoid any injuries on Sunday morning. But it's definitely a great hobby on the sports side.
Tell us one surprising thing about yourself.
I think, I'm not sure how surprising this is, but I really like getting involved in like the food and wine business. I have lent money to that space a lot in prior contexts. So maybe I employ a little bit of a secondaries mindset to my wine collecting hobby and, endeavor to have my friends and family drink as inexpensively and as good as possible. So that's a little bit of a fun hobby for me on the side.
One book you'd recommend reading.
I'm in the middle of reading kind of the anxious generation at the moment, which talks about like mental illness and kids and what's going on in the market, what's going on in that world. Um, I sit on the board of a large New York charity that addresses a lot of IDD and health and family and child wellness in New York City. So it's become something that's become much closer to my heart over the last 5 to 7 years. So I've started to balance out all the finance consumption of book and material with a lot of this stuff, which is really important and very topical today.
The most exciting part of your job.
I would say the most exciting part of my job is maybe twofold. One is, despite the fact that we've scaled really significantly, there's still so much more opportunity. So the fun part of just business building is great. And we have 100 GP relationships across private credit. So the ability to talk with some of the smartest and most interesting investors in our asset class is amazing to me. So there's not a person that we can not have access to and get their views on private credit, investing generally, how they think about the world, how they think about risk management. And it's not just, maybe the one or two people at the very top of these organizations. Many of these firms have just exceptional levels of talent throughout, and just being able to be exposed to all of those types of people and learn from them and hear what they have. I think is really interesting. It's a great perch to be on to see what's going on relative value across the world in our asset class, but also be able to speak to these people with such great experiences and backgrounds.
Final question, one prediction for the next 12 months.
Wow. I think we'll see. I think we'll see a downside negative event in the next 12 months. The market feels really positive. Probably that's not a surprising prediction from someone who's in the credit business and views the world a little bit half full sometimes. But I think we're definitely overdue for a reset. It's hard to know when or how or the magnitude of it, but it just feels like everything's priced for perfection, and there's a lot of risk on and not as much risks off. So my prediction would be there's going to be some interesting dislocation in the market, and hopefully we're in a position to take advantage of it.
And on that note, Rick, I really appreciate you joining me on the show. Thank you for your time. It's great to see you again, and obviously continued, best of luck to you and the team at Pantheon.
Thanks, Todd. Really appreciate it.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.